Did the US or EU win Trump's trade deal? Analysis and impact. In the world of global trade, few questions carry as much weight as this. Who truly came out on top in the Trump-era trade deal between the US and the European Union? The answer isn't as straightforward as it might seem. While some hail the agreement as a win for American industries, others see it as a raw deal for Europe, raising concerns about its long-term economic impact. But here's where it gets controversial. Is this agreement a masterstroke of negotiation or an uneven bargain that could destabilize transatlantic relations? Let's dive deeper into the details to understand what this means for both sides. The trade pact, announced by President Trump and European Commission President Ursula von der Leyen, marks a significant shift in US-EU trade dynamics. It introduces a hefty 15% tariff on most goods imported from EU nations into the US. This asymmetry has sparked heated debates among economists and policymakers alike. According to experts at Société Générale, this deal is far from balanced. In fact, they describe it as asymmetric and unbalanced, pointing out that the EU opted not to retaliate or escalate tensions by raising its own tariffs. Instead, the bloc appears to have accepted less favorable terms to avoid the risk of a full-blown trade war. Why did the EU make such concessions? Analysts suggest it was likely motivated by a desire to reduce uncertainty and protect its struggling industries from even harsher measures down the line. To put things into perspective, consider this. The average tariff on U.S. imports from the EU is projected to skyrocket from just 1.2% in 2024 to a staggering 17.5% based on data from Capital Economics. Such a dramatic increase is expected to shave off approximately 0.2% from the EU's annual GDP. That may sound small, but when you're talking about one of the world's largest economies, it translates to billions of dollars in lost growth. And this is the part most people miss. It's not just about numbers. It's about real-world consequences for businesses and workers across Europe. For context, EU countries export over $300 billion worth of goods to the U.S. every year, making up more than 20% of total American imports. Compare that to Mexico, which accounts for around 15%, and Canada contributing about 11%. Clearly, the stakes are high for European exporters who rely heavily on access to the lucrative U.S. market. On paper, the deal seems designed to bolster the U.S. economy. By granting American products duty-free entry into the EU, the agreement aims to boost manufacturing, farming, fishing, and ranching sectors back home. According to the White House, this colossal deal will help narrow the U.S.'s trade deficit with the EU, create new opportunities for domestic producers, and strengthen ties with a key ally. However, critics argue that these benefits come at a steep price, not only for Europe, but potentially for American consumers as well. Take Wayne Weingarten, an economist at the Pacific Research Institute, who predicts that higher tariffs will lead to increased prices for everyday goods and reduced profitability for companies operating in the U.S. Consumers and corporations will feel the pinch, he warns, suggesting that households may soon face steeper bills while businesses struggle to maintain margins. If true, this raises an important question. At what cost does America pursue these trade victories? Meanwhile, the EU has committed to purchasing $750 billion worth of energy from the U.S., a massive jump from the current figure of roughly $80 billion annually, and investing $600 billion by 2028. These commitments underscore the scale of the agreement, but also highlight the pressure on European governments to adapt quickly to shifting trade realities. Certain industries within the EU are already sounding alarm bells. For instance, Unione Italiana Vini, a prominent Italian wine trade group, estimates that the new 15% tariff will cost its members $371 million in lost revenue. A bottle of Italian wine, priced at $11.50 today, could soon retail for nearly $15 under the revised tariff structure. Similarly, Germany's automotive industry fears that the 15% levy on car exports will hurt manufacturers, even though it represents a reprieve from the previously threatened 25% rate. Despite these challenges, some observers note that the deal could have been worse. Michael Martinez, head of European economics at Societe Generale, points out that earlier fears of tariffs targeting pharmaceuticals and semiconductors didn't materialize, offering some relief to affected sectors. Still, the lack of transparency surrounding the agreement leaves room for speculation and continued lobbying efforts. So, where does this leave us? Did the U.S. secure a decisive victory, or did the EU dodge a bullet by averting a larger crisis? And perhaps more importantly, what does this mean for future trade negotiations with other partners like Canada, Mexico, and South Korea? With an August 1st deadline looming for additional agreements, the pressure is mounting on all sides. As we reflect on the broader implications of this deal, one thing is clear. Trade policy remains a double-edged sword. While it can drive economic growth and strengthen alliances, it also carries risks that ripple across borders. What do you think? Was this agreement fair, or does it tilt too heavily in favor of one side? Share your thoughts in the comments. We'd love to hear your perspective. Dollar reaches one-month high versus euro on trade deal optimism. Fed rate decision. The dollar has surged to its highest point in a month against the euro, driven by optimism surrounding recent trade deals and anticipation of key decisions from the Federal Reserve and the Bank of Japan. But here's where it gets controversial. Not everyone is celebrating these trade agreements, especially within the Eurozone. Let's break it down. On Sunday, U.S. President Donald Trump secured a significant trade deal with the European Union. This agreement imposes a 15% import tariff on most EU goods and includes a substantial $600 billion investment from the EU into the United States. This deal comes hot on the heels of a $550 billion agreement with Japan, which also features a 15% reciprocal tariff. These moves have sparked a wave of optimism in the financial markets, pushing the dollar higher. Meanwhile, U.S. and Chinese officials wrapped up 2 days of talks in Stockholm. While no major breakthroughs were announced, both sides agreed to extend a 90-day tariff truce that was initially struck in mid-May. This extension has provided some relief to the markets, reducing the immediate risk of further trade tensions. The euro has taken a hit, dropping 0.39% against the dollar to 1.154775, its lowest level since June 23rd. This decline follows a 1.29% drop in the previous session, marking the euro's steepest one-day fall since mid-May. If this trend continues, the euro is on track to record its first monthly loss against the dollar this year. Mark Chandler, chief market strategist at Bannockburn Global Forex in New York, offers some insight. After a sharp decline in the first half of the year, the dollar started July with a rebound, mostly due to short covering. The big question is whether this is a trend change or just an overdue technical correction, he explained. The dollar index, which measures the greenback against a basket of currencies, including the yen and the euro, rose 0.30% to 98.91, also hitting its highest level since June 23rd. This index is poised to record its first month of gains this year. Chandler further noted, the market breathed a sigh of relief that the tariffs, at least those announced with Japan and the EU, and the likely 90-day extension with China, have helped remove some downside risk. However, not everyone is on board with these trade deals. Several EU leaders have voiced criticism. German Chancellor Friedrich Merz warned that his country would face significant economic damage due to the agreed tariffs. France's prime minister went even further, labeling the agreement a dark day for Europe. As the Federal Reserve prepares to conclude its two-day monetary policy meeting on Wednesday, markets are expecting no change in interest rates. U.S. Treasuries slipped on Tuesday, with the yield on benchmark U.S. 10-year notes falling 8.6 basis points to 4.334%. Chandler added, "Ahead of the Fed decision, we might see some consolidation. There's concern about possible dissent from at least one of the governors, maybe Waller or Bowman." Earlier this month, Christopher Waller advocated for a rate cut at the July meeting, while Michelle Bowman, the central bank's top bank overseer, expressed openness to a rate cut in June. The Bank of Japan is also expected to hold off on raising interest rates following its meeting on Thursday, especially after the recent trade agreement with the United States. In other currency movements, the dollar was down 0.05% to 148.465 against the Japanese yen, but strengthened 0.28% to 0.806 against the Swiss franc. Goldman Sachs analysts, led by Isabella Rosenberg, predict that the next significant move for the dollar will come from monetary policy rather than trade uncertainty. They noted, "The latest trade deal announcements and limited evidence of tariff pass-through to prices have lowered inflation uncertainty and put downward pressure on implied volatility." So what do you think? Are these trade deals a step in the right direction? Or are they causing more harm than good? Share your thoughts in the comments below. Do you agree with the EU leaders' criticisms, or do you see these agreements as a necessary step towards stabilizing global trade? Let's discuss.